I'm curious, how many of you guys have ever traded Fibonacci? Please comment fibs, like the word fibs, on the comment section below so that I can see how popular fibs are. I'll highly appreciate. Anyway, today I'd like to share my best use of Fibonacci retracement. And personally, I really like fibs a lot, but I'm gonna show you exactly why. You're gonna see like why I'm obsessed, like in an unhealthy amount. I'm obsessed with Fibonacci. And yeah, Fibonacci is the main backbone of my trading system. So stay tuned to the end of this video, okay? Okay. Before I continue, I want you guys to read this disclaimer. Please know that trading is not easy, so whatever I'm going to speak or to touch on this video does not constitute to it being financial advice. Kindly note that I'm making this video for educational and entertainment purposes only. So please pause and read this trade disclaimer very carefully. I'll highly appreciate if you do so, okay? Okay. Oh, also let me mention, I'll leave this disclaimer also on the description box so that you can also read there. But if you're not able to go to the description section, you can just pause right now and then read and then continue the video, okay? Okay. Now, what is Fibonacci and why is it very popular in trading or in the financial markets? So let me give you a very brief summary of Fibonacci before you continue. Basically, Fibonacci is based on the Fibonacci sequence, which is a series of numbers where each number is the sum of the two preceding numbers. I've put an image down here, like on my presentation, you'll see like 0, 1, 0 plus 1 is equals to 1, 1 plus 1, 2, and so on and so forth. And the sequence continues infinitely, like to infinity. It has no end. So yeah. So this Fibonacci sequence now is the backbone of Fibonacci. That is Fibonacci retracement, Fibonacci expansion, and so on and so forth. All the theory is based on Fibonacci, that is. Now, who invented or who came up with this Fibonacci? So, Fibonacci was actually not invented for trading specifically, but its application to the financial markets is credited to Leonardo Pisano, also known as or nicknamed. He was actually nicknamed Fibonacci, and he's an Italian mathematician. So this guy, Leonardo Pisano, actually people like to call him Leonardo Fibonacci. He's the guy who came up with this theory of this theory that we now call Fibonacci. I hope that is clear up to there, okay? So for him, he just made a discovery and later, and actually even wrote a book, I think. Then later, people now started building on what he had found out. And now we credit, because someone's work has to be credited to the inventor, we now credit it to him. So that's why it's called Fibonacci sequence. Actually, it's called the Fibonacci sequence, or now it's the theory, and then now it has all these other things like the Fibonacci extension, the Fibonacci expansion, and so on and so forth. So the Fibonacci sequence is often found in nature, and it is believed to be the fundamental part of the natural world. So we have things like the spiral patterns found in seashells. I think you can see this diagram here of this diagram is like a representation of the Fibonacci sequence. So we have the spiral patterns found in seashells, pine cones, and sunflowers. They all follow the sequence, and also the branching patterns found in trees and rivers. So basically, this diagram shows now the Fibonacci patterns. You can go and Google Fibonacci sequence, and you can search on the images section, and you can see all those things in nature that go with this. Also in art, you'll find a lot of art having or rather respecting this sequence. So go and find out, okay? So Fibonacci sequence data is normally predictive, like the Fibonacci sequence or Fibonacci patterns, that data is normally predictive. And as always, I like to give you guys an analogy so that you can always remember some part of this information, maybe by remembering this analogy. So you need to know that data collected for generations can show patterns and help predict outcomes, okay? So for example, different patterns can show or even before natural events appear, like rain. So let's take the example of rain. So days beforehand, farmers could anticipate rains in few days by looking at the birds and the trees and how they behave. Like, I don't know about your culture, but I know in most cultures they used to anticipate rain and they would look and observe the nature to kind of predict whether it's gonna rain or not. So farmers in those times, they would take these patterns very, very seriously to maximize on the rains that are coming. So for us traders, the same applies. We rely on fibs to predict the market at a somewhat high success rate. Because remember, the Fibonacci sequence is ingrained in nature. Same case with the financial markets. And by the way, I'm saying the financial market because it constitutes of people like me and you, traders like me and you, who are real human beings. We are all natural. So we have the different emotions. Even if an algo is trading, those algos are written by humans. So the human nature, that is a very natural state. So at the end of the day, patterns like this repeat themselves. Okay, I hope that is clear up to there. So now that you've heard about my analogy, let's get into now the Fibonacci in the financial markets now. Although the Fibonacci sequence was first invented by or first discovered by the famous Italian mathematician Leonardo Pisano, the person who first developed the idea of using the Fibonacci sequence in finance was actually Charles Dow. And he's one of the founders of the Dow Jones Industrial Average. So according to Charles Dow, he noted that after moving along with the main trend, price often retraced before resuming its prior movement. And he concluded that the latitude of this retracement was between 33% to 66%. Now, this concept was later refined by a stock market analyst named Ralph Nelson Elliott, who gave even more accurate retracement levels, like for the Fibonacci sequence, the 38.2% and the 61.8%, and for stock price tendencies, the 50%. And actually, these levels are the main levels of the fibs. Some of the main levels, there are others, but these are some of the main levels of fibs. I think I need to talk a little bit about Ralph Elliott. Let's call him Ralph Elliott. So in the modern day, this is the guy who actually popularized Fibonacci retracement analysis, and I think you guys may know him. You may actually know his work. His work is widely used by a lot of traders, and I'll make a future video about his work. So that's why I think I needed to touch on him here, and then I'll give you another video because he has a whole very wonderful strategy that you guys can also benefit from it. But let me just briefly tell you about this guy. So Ralph Elliott applied Fibonacci analysis to financial markets in his theory of Elliott wave analysis. Okay, so which suggests that market trends follow a repetitive pattern of 5 waves in the direction of the trend, followed by 3 corrective waves. Okay, I won't go into detail about that, but you'll see later how Fibonacci and Elliott wave analysis comes in handy. But in future, in this video you may see in your mind, but in future I'll create another video specific for Elliott waves. Okay, Now, Fibonacci analysis has been adapted widely to help traders analyze the financial markets. Although it shouldn't be used in isolation, that is, you always have to use confluence when it comes to Fibonacci, it remains a very popular tool among traders due to its ability to identify potential support and resistance levels, and in simpler words, entries and exit points for trades. Fibonacci is simply a predictive tool, and when applied correctly, it can highly benefit any trader who has mastered it. Another thing is a lot of indicators and strategies normally utilize Fibonacci. I know a lot of you guys, if you have at least traded for some time, you have noticed that. And maybe if you're a beginner, you may not know this, but please know that a lot of strategies and indicators normally use Fibonacci, and I know you guys can mention a few of them. And Fibonacci is the most used technical analysis tool in TradingView. So let's find out why fibs are the most relevant. Okay, let's see the beauty of Fibonacci. We can never work with fibs without understanding market structure. So I won't go deep into market structure, but I need you to see the bigger picture of the market so that you are not confused, okay? Because if you happen to be confused when using Fibonacci, my friend, you will be on the wrong side of the trend all the time. So to avoid confusion, I need you to master. It's very simple. It's a very simple topic, but please, at your own time, please master market structure. It is one of the simplest topics in trading. But of course, if you want a thorough presentation on market structure from me, please write down on the comment section market structure, and I'll see how many people are interested and then make a video for you. Okay, about market structure. Before entering a trade, you definitely need the bigger picture. Others like to call it bias, so they can say daily bias, weekly bias, and so on and so forth. So bias, like what do you think the direction of price is, or rather, where do you think price is trying to get to? A good time frame for market structure is actually the 4-hour and the daily. Those two time frames are very good when it comes to showing you the bigger picture of price. And these two time frames, they clearly show you market structure. Like, they can show you the clean market structure, so you don't have to struggle. Like, for me personally, I like going, instead of going to the 1 hour to look for market structure, or the 30 minutes, or the 2 hours, or whichever time frame you want. This is a hack. Like, from me personally, from my back testing, just go to the daily or the 4-hour. You will see very clean moves. Like, you'll see a very clean market structure there. But again, that's just my opinion. So yeah, so market structure basically shows us the journey of price, and we know about the uptrend market structure, the downtrend market structure, and the consolidating market structure. So in the creation of higher highs and higher lows, and lows and lower highs, the market creates impulse moves, then corrections, then impulse moves, and so on and so forth. So I've demonstrated with this graph that I've put here for both uptrend and downtrend, and as you can see, we have an impulse, correction, impulse, correction, impulse, and on the downtrend you have impulse, correction, impulse, correction, impulse, and each of these moves, they have retracement levels, and these retracement levels, they find support and resistances on the fibs. So these retracement levels are the fibs, at the fib levels. I hope it makes sense. Now we have officially introduced Fibonacci retracement, because basically they come from market structure. Okay, so market structure gives birth to Fibonacci retracement levels. I hope it makes sense. Okay, I know it's so simplistic, but I need you guys to understand this. Okay, so now the level where the correction finds support or maybe resistance, that's where the fibs are. Okay, those support and resistance levels are the Fibonacci retracement levels. Let me show you on the chart. And remember, I told you guys, it's subjective, it's according to me. I like the 4-hour and the daily. So we'll go to the 4-hour and the daily charts first. I didn't say you trade at those level or those time frames. I'm saying we start our analysis on the daily or the 4-hour. Okay, get me right. So here's the chart, and you'll notice that it's to the T. Like, price often wicks at those levels, making it a clear sign of a support or resistance level. So that rejection at the retracement level can tell you that now, pay attention, we are at a support or resistance level. Basically, that's what Fibs does. It tells you we are now at support, we are now at resistance, while price is on the move that it is in, like whether it's an uptrend move or a downtrend move. Yeah, so you can pause and look at this chart. Just try to look at it, and then once you are satisfied, you can now move on. Now, we won't directly trade the Fib level. We'll actually need confluence. At least one confluence is enough. You can have 2, you can have 3, but 1 is enough. But before we talk about the confluence we need, I need you to understand. I want you to note that price doesn't trend eternally. Like, price doesn't trend forever. Like, if it's in an uptrend, it won't go up forever, or down forever, or consolidate forever. I know a lot of you guys may be caught in that part. A lot of traders are actually caught thinking that price will go on forever and ever, not knowing that it has ended, now it's going the other way, and so on and so forth. So I want you to put that before entering any trade. Always know price doesn't trend or doesn't go on whichever move it decides forever or eternally. Okay, I'm saying forever. Of course, it's not realistic, but I just want you to know that I don't want you to be caught, because some of you will be caught by thinking that, okay, since the Fibs level are respected, you are continuing the uptrend, forgetting that now there's a possibility that price will either consolidate or start reversing and now having the downtrend. Okay, hey, I've explained so much, so let's continue. But please always remember that, save this tip at the back of your mind, and it will help you a lot in avoiding confusion and reducing unnecessary losses. Okay, now let's talk about this. There are 3 levels to a trend. So level 1, we have the trend is very strong. Level 2, now the trend is kind of weakening. It's still trending, but it's weakening. And then level 3, the trend is very, very weak. And now indecision has crept in. And now this is where you start seeing consolidations. Definitely price is looking to reverse at this level, so please pay attention to that. But I know a lot of experienced traders know that already. Maybe they may forget that, but yeah, let me just remind you. And it basically means that the end of the trend has occurred, and now we are starting to face the opposite direction. Or maybe some major thing may occur and price may continue going wherever it wanted to go, because there are other factors other than the technical factors and fundamental factors. There are major events like war, this and that, sickness and all that may lead to price. But it's not often, but it may occur. So normally, either way, remember, trading is a game of probabilities. So either way, I'm not saying that this is what will happen, but most chances that is what will happen. Don't get me wrong, okay? Okay, I'm having fun making this tutorial so far, and I know I'm talking a lot, and a lot of people who may have never encountered this channel may be wondering, oh, this chick is speaking a lot. But yeah, I'm in the zone, but yeah, you can speed the video if you want to, but I'm continuing to give you value. Okay, let me continue now. So, by now, you've noticed that Fibonacci is mostly used for trend trading. That is by trend traders. The people who trade Fibs, they normally like to call themselves trend traders because they like to catch the trend and or move with the trend and so on and so forth. Each retracement level can show you whether a trend is weak or strong. And another thing, we normally have consolidations, not to mean that we don't trade consolidations, but there's a different approach when it comes to consolidation. So that's why you'll find different traders have different strategies for different market structures, because you can't trade fibs successfully when it comes to a consolidation market. I hope it makes sense. So fibs are perfect high win rate when it comes to trend trading. And in future, I'll teach you now how to trade consolidations. Now here we have channels like parallel channels and so on and so forth. So in arranging markets, please don't consider using Fibonacci. Please don't. You'll lose. So if you don't know how to trade arranging market, stay out and wait for when now the market decides to trend. Okay, confluence. Now we are at confluence. So the main confluence that I'd like to share with you today is fair value gaps. I know a lot of you know about it, especially the ICT people, but it has been there for very many years. So don't credit this to ICT. No, it has been there for ages, for years and years and years. Other traders like to call it imbalances, but we're going to call them fair value gaps. In short, FVGs. If you don't know about that, I made a TikTok video, or rather a shorter video. You can check in my channel in the previous videos before this one. You can find, and then later in future I'll make a more presentable video about fair value gaps. So again, if you want to a more updated video on fair value gaps, write on the comment section fair value gaps / imbalances if you're nasty. Okay, I'm joking, please. And of course, there are other confluences. I'm not saying that fair value gaps is the only one. There are other confluences, but for me, the one that I find it to be best is FVGs or imbalances. And they are very, very important in market structure as well, and they're very important for trend trading. First of all, you'll notice that price mostly finds support at or resistance at the fib levels that are in fair value gaps. I want you to go to your charts and backtest. Please backtest to see that what I'm saying is actually true, and that is what actually happens. So it happens a lot. So you can go, you can see that I'm not lying to you. Note, I'll need a part 2 to elaborate on this, because I don't want to make this video extremely long. Already I think I've covered 20 minutes, and I think I'll subdivide this video into 2. So let's call this part 1, and then part 2 I'll cover now the more technical things. But let me finish up on this presentation, and then so that it doesn't become very, very long, so that it may help a lot of people. It will be more helpful to more people if we subdivide it into 2. I've noticed I'm speaking a lot, and it could mean I have a lot to share, so please don't crucify me. I have a lot. Maybe that's how my mind is working, so it is a good thing. It means I know a lot about this craft, okay? And I'm sharing with you a lot about this craft called trading. Now I've given you homework. Kindly go and backtest and see if the retracements are at the fair value gaps. And note, we have 2 fair value gaps. Namely, for those who may not know, we have 2 types of fair value gaps or imbalances. Namely, the bullish fair value gap, that is for the uptrend, and the bearish fair value gap, that is for the downtrend. So fair value gaps are the perfect confluence, and they offer very, very good entries. And side note, but I'll share with you in the next video, please note that I always enter my trades at fair value gaps. That is a very, very thing I want you to understand. I like entering my trades at fair value gaps. no matter the strategy, I like fair value gaps a lot as well. So here's another chart, and I want you to see how precise the fibs and fair value gaps are. As you can see on the 0.382, there's a fair value gap there, and it rejected perfectly, and then shoop, it went up. And also on the 0.786, we have another small, very small, I know you may not notice it, but it's very small, very small. You'll notice it in the lower time frames, and I'll teach you that in the next video, because of course you're not going to trade the daily or the 4-hour. As day traders, you're going to go down, to go lower, so you'll come to see it now beautifully. After this this fib has created the base, now when you go lower, you'll see this is a nice fair value gap. So this is actually very nice, and it has rejected perfectly at the 0.786, and shoop, it went, although it didn't go so high, it went shoop a little bit. It offered us a very good risk reward and a good number of pips. Okay, let's continue. So we are almost done with this video, but let me mention quickly the key fib levels. I'll be showing you the settings and all that nice stuff. So here is a little tutorial on how to set up fibs and input the important retracement levels. I'll go deeper on these levels in the next video, but for now I need you to observe and see these settings. So head over to your trading view. This is where you find the fibs. You can decide to star it. When you star that tool, it goes to your favorite bar. So for me, it's below here. So you can star it. But since now we'll be using fibs, I don't know if you'll decide to be using it often, you can star it and make it and add it to your favorite toolbar. So pause to see this settings. Just pause and then insert these levels into your settings on your fibs tool. Okay, so I've demonstrated some 2 examples. Always left to right when drawing fibs, but I'll go deeper in the I know I'm saying that a lot, but yeah, I'll demonstrate that well in part 2. But actually it's very simple. Find the swing low, swing high, left to right. On an uptrend, we are finding support. On a downtrend, we are finding resistance. Yeah, I'll give you a little homework. So I told you to go and backtest, so please backtest on 3 different pairs. You can also forward test on demo and start practicing there. So if you don't have a demo account, you can check the links on my description. You can find a demo account, so you can start practicing there. Although you are not using your funds or real money, it will help you practice the strategy. Later you learn that trading requires also risk management and psychology, and those will be mastered or will be practiced when you use real money. But for now, please use demo. And note, the formula is key fib levels, the ones that I've told you to insert in your fib tool, those settings, and then in combination or in confluence with fair value gaps. Okay, so let's conclude. Okay, I hope it has all made sense so far. Please, I hope it has made sense to you. And in case you have any questions, please leave them on the description. Leave them on the comment section below. Before preparing the next presentation, I'll go through them. But anyway, even if I can make a shorter video for you in future, just write on the comment section whatever you don't understand, or if you have any burning question, I'll cover it specifically for you. So yeah, I hope everything has made sense so far. So in part 2, this is what we'll cover. So here are the main topics that we're going to cover. Number 1, how to correctly identify swing highs and swing lows. I'll teach you that. Number 2, how to correctly plot fib levels to find support and resistance. I'll teach you that. Number 3, most important fib level of all and why. The most important fib level of all. This is the level that if only you just trade that level alone, you'll never go wrong. Actually, you have almost a near perfect winning, like a near perfect win rate. Okay, yeah, it's a very, 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 very nice level. But I know a lot of us don't use it because, first of all, it doesn't mean it will appear every day. So because of that, we may become greedy and not wait for it. We may become even impatient and not wait for it, and so on and so forth. But I will show you that whenever you see that level, whenever you take a trade, you'll always be winning. Actually, let me not say that. Most chances are you will win. High chances are you will win. Remember, it's not 100%. In trading, we never do 100%. Actually, we are always supposed to think that you're gonna lose. But yeah, that level, I want you to respect Fibonacci. I want you guys to see how Fibonacci is very, very important. Okay, I'm blabbing. So next, I'm going to show you how to confirm the fair value gaps for day trading and scalping. And I'm going to show you how, number 5, I'm going to show you how to trade Fibonacci in lower time frames, that is for day traders. So I'm going to now take you to which level. So I've said the daily and the 4-hour. Now which level, or rather which levels are we supposed now to enter our trade? Which levels are we supposed to go to so that we can find good entries, good exits, and so on and so forth. Next, we are going to learn what each fib level tells us about the strength of the trade. We need to know, when we see this level, what does it tell us about the strength? Is the trend strong? Is the trend weakening? Or is the trend weak, like we are now, it's almost over? Okay, and then lastly, I'm going to show you how to take profits and how to place stop losses, or rather, I'm going to show you how to set up targets and know where your invalidations are. So, just a bonus, I'm gonna also show you, or rather, we are also gonna discover the win rate of this simple but powerful strategy, and of course, I'm going to share with you proper risk management when it comes to Fibonacci. So I know you'll be excited to know the win rate. It's actually very high. If you master and practice and apply Fibonacci correctly, and a lot of times, my friend, you're going to be having a very, very high win rate. Of course, we have to remember, not always, but most times. So trading at the end of the day is a game of probabilities. You may have a high win rate, but if you don't apply proper risk management, you never know where. Maybe we say we have a high winning streak, like we have trade 1, trade 2, trade 3, trade 4 has been won, but you don't know if trade 5 is going to be a loss, or even trade 2 is gonna be a loss. You can have, like, out of 10 trades, you can have 8 of them being winners, but 2 of them may be anywhere in between. So we don't know which one is going to be a loser. So if you don't apply proper risk management, you may even blow your account, even if you have a very high win rate. So that's why I'm going to share about proper risk management. So yeah, that's it. We've covered everything for part 1. I hope you'll be excited for part 2. Please, guys, remember to like, remember to subscribe, remember to hit the notification bell so that you don't miss the next video. And I hope I was helpful to you in this video. If you need any resources regarding to trading, you can check the description. And yeah, I think that's it. Thank you so much, guys, for being with me throughout this tutorial. And yeah, see you in the next video. Remember, if you have any question, in the comment section below. Okay, and guys, if this was helpful, please share with you in any of your community. if you have a trading community, you can share this video with them. I'll highly appreciate. Okay, so yeah, that's it guys, and see you in the next video. Bye.